And again, welcome and thank you very much for joining us. And Happy New Year. I hope that you all enjoyed a very meaningful holiday season. And we're looking forward to kicking things off here this year. So we thank you for joining us as we kick off the Kerby Center's 2022 series of exciting and informative online health and wellness, information, education, and entertainment presentations. It has been a tough couple of years, and as we enter this new year, many of us are looking forward to taking charge of our well-being and reclaiming our emotional and physical health and wellness and our financial future, renewing our purpose as we age gracefully. It is our great hope that our presentation will help to provide you with the information that you need in order to make informed decisions about your health and wellness and to help you live your best lives. Part of our emotional well-being is precipitated by our financial health, and many of us may have found ourselves of late in a precarious financial position, particularly following the indulgence of the holiday season. You may be wondering, how did I get myself into this debt and how can I manage it? Or simply need help in managing budget and finances so that you don't find yourself in that situation. Today, we're very pleased to welcome Donna Carson, Senior VP with MNP's Insolvency and Restructuring Group. Donna oversees the practice in the Calgary, Drumheller, and Central Alberta regions. With 30 years of experience, Donna has worked with a wide variety of individuals, businesses, and industries in helping them deal with their financial situations. She consults on the range of options for resolving debt challenges, including budgeting and cash flow management, debt consolidation, consumer proposals, and bankruptcy. Donna is a chartered professional accountant, a licensed insolvency trustee, and a member of the Canadian Association of Insolvency Restructuring Professionals. Actively involved in her professional and personal community, Donna has been a board member of the CNIE Committee, the National Insolvency Exam, the treasurer of the Western Canadian chapter of IWIRC, the International Women's Insolvency and Restructuring Confederation, and currently a board member for Money Mentors. She is also recognized in her field and speaks at conferences about insolvency, including the annual CAIRP conference, family law conferences, CBA Bar Association, and Legal Education Society. She's also regularly sought out to speak to radio, print, and television media about personal insolvency topics. Donna, you're a very busy girl.
It sounded busy when you said all that, didn't it? But it's yeah, well, it's not all at once.
We're very happy to have you here and anxious to learn from you today. How do we avoid getting ourselves into financial crisis, and what do we need to know in order to get out of it if we find ourselves in that position?
Great question, and thank you, Colleen, and welcome everybody, and Happy New Year. When it comes to financial wellness, sitting here in January at the start of a new year, new goals, new perspectives, it's a great time to look at our finances, look at our budget, and look at what we see for this coming year and the years ahead as well. And so that's kind of an oversight of what I'm going to touch on today. And Colleen, I guess if you watch the chat and you see a question, please let me know and jump in.
Yeah, absolutely. Would you like me to ask them as they come up, or we'll just save it until the end and then address them?
Maybe at the end?
Sure.
Yeah, okay. So just to give you a really quick idea of our firm, yes, it's M&P. It used to be known as Myers Norris Penny, if you have heard of that firm. We started in 1945 in Brandon, Manitoba, with 3 partners, and now have expanded right across the country. We're the 5th largest advisory and accounting firm in the country. And we have just about 7,000 team members now and 100 different offices across Canada. And as Colleen mentioned, I'm a licensed insolvency trustee. I manage our insolvency practice for the South Central regions of Alberta. But we do have offices and satellite offices as well right across the country for when people do need to reach out to us and talk about how to deal with debt. And that's not everything I'm going to talk about today. We're going to talk about financial wellness, We're going to talk about budgeting. We're going to talk a little bit about some tips when it comes to budgeting, hopefully geared a little bit more to the audience today. I'll touch a little bit about credit rating, and if you've never seen your credit report before, what is it I'm looking at? What is good debt? What is bad debt? And if that debt has started to grow a little bit more than what I'd ideally like to have it at, what are the rights of those creditors that I do owe money to? And then what are my options as well to deal with that debt? So what is financial wellness? It is so individual and so personal to each individual person. Kind of the same, if you will, of looking, if you have a $10,000 credit card, to this person that may feel like $10,000, and to the next person it might as well be 100,000. It's a very personal state as to what our financial wellness is, and it does not matter, necessarily what your income is, because it's different definitions of financial well-being. And so having financial wellness means having some financial security. It means being able to have freedom of some choices when it comes to my finances, both today and in the future as well. It depends on the person. It depends on what my perspective of money is, how my emotions attach to it, what my emotional state is right now as well. And in a nutshell, I guess it really is, what is my relationship with money? That essentially is what financial wellness is. So how do we get there? How do we get to the state or work towards it, at least, of feeling that financial wellness? Well, one of the biggest things is budgeting. And I put a character up here, the seniors discounts and other discounts too that are out there. It'd be nice to have the money for it instead, but unfortunately that's usually not the way that it works. But budgeting is one of the key tools to attain that financial wellness for today and the future. And it is taking that lifetime of income, 40 or 45 years of working, plus then my retirement income, and it's taking that 75, 80, whatever it is, years of income and stretching it over my entire lifespan. That is really what budgeting is. Budgeting gives you a clear picture of where your money is and where it's going. And the first way to get there is that you need to know where you're at right now. I can't get to where I want to be if I don't know where I'm at today. So tip number one, if you have not yet ever created a budget, and budgets evolve too, so maybe it's changed since the last time you looked at it. So tip number one would be to write it down, track it for a few months, keep all your receipts for your income, for the money going out, and then sit down and put each of those receipts into categories and then add it up. What is my grocery budget? I think it's $500 a month, but am I really spending $600 a month right now? So keep some receipts for a while. Then to identify what your needs and wants are and prioritize them. And again, that's a personal decisions as to what's prioritizing for me versus somebody else. So once you've tracked everything that I spend right now and need to plan for, which ones are priorities? Maybe all the entertainment stuff isn't priority number one, but paying the rent and buying groceries is. Make a list of all your debts. Who do I owe money to right now? If I've never made the list before, it's really good to write it down, write down the amount that you owe, write down what the minimum payments are so that you know what the minimum amount is that I'm going to budget for, and write down what the interest rates are on each of them. And I'll show you why that is important here in a minute. Determine what your goals are, both your short-term and your long-term goals. So for example, a short-term goal might be paying off that $5,000 credit card this year. That could be a more short-term goal. A more long-term goal might be planning for a vacation in 3 years, that dream vacation that we have. So what are my individual financial goals? Setting a goal for emergency fund. I remember years ago when I first started, we used to talk about 3 to 6 months of my basic living expenses, having that amount of money set aside into an emergency fund. Now you hear more about 8 months of basic expenses set aside in a separate account for those emergencies that happen. If something happens with one of my sources or all of my sources of income, do I have enough to cover the basics, the rent and the groceries? Again, maybe not the eating out, but enough to cover the basics. That is what an emergency fund is about, is to cover those basic expenses if something happens with my income. And then there's another type of expenses to plan for. We call them annual or irregular expenses. And we have a chart on our website as well that helps you to brainstorm, I guess, what these annual irregular expenses are. Those things that creep up once a year that I didn't plan for or wasn't expecting it. So once a year, maybe it's repairs for my car. I don't know what it's going to be, but once a year there's something. Or I have to pay my property taxes by June 30th, or that vacation once a year. Those would be some examples of annual or irregular expenses. So that is a little bit of how we're going to start to plan for the budgeting. Know where I'm at today. What are the benefits of doing this budgeting? Well, it gives you a clear picture of where I'm at so that I can then make decisions from there. I can set my own boundaries and my limits. I'm now in control. One of the scariest things when it comes to money and planning and budgeting is not feeling in control. So knowing where I'm at and writing it down gives you a little bit of sense of control. And it also helps you to then prepare for these emergency expenses, these unexpected things. It also helps you, prevents you, from spending money you don't have. Credit is not income or a backup plan. Ideally, we want to budget with our income. We have emergency money. We're not using the credit to do our day-to-day or month-to-month budgeting. Budgeting also helps us shift a little bit of our mindset from, buy now, pay later, which we see a lot of out there, to more of a budgeting where we are planning now and paying now instead of paying later. I can also use the example of, let's say we are budgeting $500 a month for groceries. And if we are not tracking to know where I'm at in that $500 spending and I'm putting it on credit, now I'm going to be next month on my credit card having to pay for last month's groceries as well. And that can be kind of a cycle of how our, with all good intentions, I had a budget, but I didn't quite stick to it. And we want to help you achieve your financial goals. So those are some of the benefits, really good benefits of budgeting. What are some tips when it comes to budgeting? So the first one is to balance it to zero. Here are all my sources of income, and I'm planning it out to month-to-month expenses, emergency money, annual expenses, and at the end of it, I'm budgeting it to zero. Because that includes savings, like we mentioned in number 3 here, to be paying yourself first. Paying yourself first and budgeting for your savings, for emergency money. Maybe it's estate planning right now or leaving money as an inheritance. But at the end of it, we have planned out our entire income. And to also avoid overextending yourself. That is probably goes without saying, a tip in budgeting. And try not to, when you're budgeting, try not to spend more than 35% of your gross income on your housing expenses. So whatever your gross income is, 35% of that should be your utilities, maybe your mortgage, property tax, repairs. That would be the ideal budgeting of not overextending yourself when it comes to housing expenses. Again, paying yourself first. So maybe we've set a short-term goal this year that I would like to save up, I don't know, $3,000 over this year and put it into an emergency bank account. And it doesn't happen overnight, so I have to plan for it. And to get there, pay yourself first. On the first day after my income comes in, that money goes out into the emergency money so that it's done and it's gone, and now I'm living for the rest of the month. If I go to put that money into my savings or emergency money at the end of the month, we may have spent it already on something else. So pay yourself first. The government benefits, ensure that you're aware of them all. And I know they've got lots of information at the Kerby Center and online as well about all the different federal, provincial, the medical benefits, rent assistance, property tax assistance. Ensure that you're aware of all the different benefits that you may qualify for. Or last year, there was some different CERB benefits for seniors, things like that. Take advantage of those different discounts and coupons that are out there. Every one of those little dollar coupons and adds up over 365 days a year. It can add up. Can you bundle in your insurance? Can you take all the different insurances you have? Medical, travel, life, home, contents. Can you take all those different types of insurance and bundle them into one service provider? And if I can I save money doing that versus having 3 different service providers perhaps? So take a look at your insurance as well to see if we can bundle them to perhaps save some money. Have you comparison shopped recently? When is the last time we looked at our insurance, our bank service fees, our utilities, our phone, our internet, our TV? When's the last time we've comparison shopped on the different service providers that are out there and asked them, can you bundle my cable, my internet, my phone, and lower the payment for me? If we don't ask, we don't get. So make sure you, especially if you haven't done it recently, to comparison shop. Try to prioritize paying off debt. And I'll show you here in a minute what it can look like if we don't pay off that debt. So again, as we talked earlier, write it down so that we know where we're at. Building that emergency money, 6 to 8 months of basic essential money set aside. And I always say, set it aside in a separate account. It's not mixed in with your day-to-day bank account. It's set aside in a separate account. You want to keep it in something liquid. You're not going to lock it in a 1-year GIC, and it's definitely not in RSPs or RIFs or anything like that. It's in a bank account of some kind that's easily accessible when I need it. But on the flip side, make it a little bit tough to get at. Maybe you don't have a debit card on that account. Maybe I have to go to the bank to get the money out. So I'm consciously thinking of, is this what we meant to use that emergency money for? Try to have separate bank accounts for your day-to-day banking, for that emergency money, and then those annual expenses like a vacation and things like that. And so when we've planned out our budget and we are using and putting money into those accounts, having the separate bank accounts, subject to what the service fees may be, but having those different bank accounts can help to stick to the budget and then track it. And we'll talk a little bit here in a second about how do I track it. And the biggest tip there is to keep it simple. If we make whatever method we're going to use to track our budgeting, if we make it too complicated, it's going to become stressful. We'll stop doing it. So we want to keep it simple. Budgets evolve. Just because January of 2022, I set a budget of X doesn't mean in June of 22, it's going to be the same budget. Budgets evolve over time. So make sure you're watching them as your life changes and make it a family affair. Discuss it together with your spouse, maybe with your children as well. That could be part of estate planning, even, discussing what my finances are with family members. So just some quick tips on budgeting that hopefully you can pick 1 or 2 out of there. And then how do we track it? Well, we can track it the old-fashioned way, or we can track it through some technology and some apps. So a couple of the old-fashioned ways, if you will. One is a spreadsheet. If you are apt or a person who uses Excel and spreadsheets or even handwriting spreadsheets. So let's say we've budgeted $500 a month for groceries. So on my spreadsheet, I have $500 a month written at the top of it. And then on the side of the spreadsheet, we've got the different, 1 to 31 days of the month. And let's say on the 5th of January, we spend $100 on groceries. So now we have $400 left in the grocery budget. Then on the 10th of the month, we spend $50 on groceries. So now we have $350 left for groceries for the rest of the month. And then the same for each of the different categories, our entertainment, our gas, all the different types of categories you may have. And then you track it as to what I've spent and how much is left. And that will help you. Let's say you get to the 25th of the month. I spend $50 on groceries, but I don't have $50 left in my budget to spend on groceries. Now I can see, where do I maybe have some money left and I could pull from it. So I'm consciously still sticking to my overall budget. I've just reallocated a little bit for the month. Or maybe I can live with what's in the cupboard, so to speak, for the last 5 days of the month. So that would be the spreadsheet way. Then there's also, envelopes and jars, if you will, but what the essence of that is again, the $500 a month grocery budget. On the Sunday night, we pull out $125 one quarter, and that is my grocery budget for the week. And I put that actual cash maybe into an envelope or a jar, and that's the money I use when I go grocery shopping. And so when that money is gone, I physically actually see it. Physically seeing cash for some people can be easier than maybe using a debit card, or a better way to stick to my budget than using a debit card. So those would be some of the old-fashioned ways, if you will, of sticking to a budget. And then there's apps if you are a person who can use or apt to use these apps from different banks. Most of them are free. So the big banks all have some type of budgeting apps to help you stick to it. Or I've listed 4 other ones here on the internet that help you to track and stick to that $500 a month grocery budget. So those are just some general thoughts, tips on setting a budget, some tips in creating it, and some tips then on how to track it and stick to it. What I want to show you here next is, what if I haven't been able to stick to it, or life has happened and I have a $10,000 balance in this example on my credit card. And I've used an annual interest rate of 19.9% in this example, which on some credit cards might be low actually, but that's what I've used in this example. And let's say the bank requires a minimum 3% payment, so that would be $300. So when we sat down a few slides ago, I've written down I owe $10,000, my minimum payment is $300, and my interest rate is 19.9%. So in this example, the first month, your interest is going to be $165. So when I paid $300, that means $135 is going to apply to the principal that's owing on that credit card. So that's our starting point. So under payment option A, we're just going to pay the $300 minimum every month. It's going to take me 18.5 years to pay that off. I will have paid just over $11,500 in interest on the $10,000. So I'll have paid just over $21,500 on that $10,000 credit card, if I can only pay the 3% minimum. Now, what if I could pay a little bit more? As I looked at my budget, let's say I could pay an extra $50 a month to try to get rid of this card. So I'm going to pay $350 each month towards this debt. Now it's going to cut down how long it will take me by over almost 10.5 years. It's going to take me just about 8 years to pay that off instead of 18. And I will pay just over $6,300 in interest, so $16,000 in total. So I'm going to save about $5,200 in that interest if I could just pay an extra $50 a month on this particular card. Now, let's say when I looked at my budget, I've really made it a priority to pay this down, and I'm going to pay down at $500 a month. Now I will be done with this card in just over 2 years. I'll pay about $2,250 of interest, so $12,000 in total. So compared to option A, now I'm saving myself 16 years and I'm saving myself over $9,000 in interest if I could prioritize that one payment each month to get rid of this debt. And on the flip side, what if I can't pay the minimum payment? And this ignores whatever the creditor's rights may be, which I'll talk about here shortly too. But let's say I can only pay $220 a month towards this $10,000 credit card. Now, barring the creditor doing anything to try to collect this debt, it's going to take me 30 years to pay it back. And it's going to cost me almost $23,000 more in interest than option A did. So there's lots of amortization schedules, they're called, on the internet. If you just Google amortization, you'll find one easily, and most of the banks have them as well. But this just gives you a quick idea as we're prioritizing to pay down our debt. What would a $10,000 card look like if I don't pay it all off? Same kind of thing on a mortgage. For those of you maybe who still have a bit of a mortgage left on your house, in this particular example, I used a $300,000 mortgage at a 2.94% interest rate, typical amortization of 25 years, and my monthly payment on my mortgage is just over $1,400 a month. So if I pay my regular monthly payment under option A, I'll have paid back just over $123,000 in interest. But I would purport that, or I'd call that what I say is good debt that I'll talk about in a minute, to have a mortgage and building up equity in my home. But what if, under option B, what if I could start to pay that $1,400 twice a month? I'll still pay it off over the 25 years, but I'll save a little bit of money on my interest, not a lot yet. But what if now I could break it down and pay it every 2 weeks? If I could pay that mortgage, so it's $705, most months, it's the same $1,400 mortgage payment, but twice a year, I'm going to have a third mortgage payment in my budget. That's what a biweekly accelerated payment means. Now I'm going to save about $15,000 of interest, and I'm going to pay my mortgage down about 3 years faster. And in example D, what if I could pay that mortgage down bi-weekly, and once a year I can plan for a $5,000 lump sum payment as I'm looking at my budget. Maybe I plan for $5,000 to go towards my mortgage. Now I'll pay it off almost 3.5 years faster, and I'll save about $20,000 in total on my mortgage. So in a nutshell, if I can start to pay down the debt faster, the interest saves up for sure. Now I want to talk a little bit about your credit rating, your credit score. I don't know if all of you have ever seen your credit report before, and I'll talk a minute about how to look at it, but sometimes it's called a credit score, credit rating, a beacon score, FICO score, different things like that, but it all means the same thing. And a credit score is made up of different information that the credit bureaus have about you. And this pie chart here shows you what goes into that credit rating. It is, what's my payment history been? How much do I owe on each of those credit products? How long have I had the credit? Have I applied for any new credit lately? And what types of credit do I have? Do I have a mortgage, an installment loan, which would be like a car payment, or a revolving type loan, which would be like a credit card or a store card? All of those different things, plus how often do I move? How often do I change jobs? What's the purpose of the loan? What's my net worth? My assets minus my liabilities? All of those different types of things go into what is my credit score. And your credit score is a number. It's a number between 300 and 900, 900 being perfect. So an average score would be 600. And this chart here shows you a good credit rating. They call a score from 660 up to 724. That would be what's called a good credit score. And if my score has fallen below that, depending on how low it has gone, it might be considered fair or poor even. And if my score is higher than the 660, it may get into then the very good or the excellent range. And how does the credit bureau come up with this magic number? So there's two credit bureaus in Canada. There's Equifax and there is TransUnion. And what they do is they keep 6 years worth of information about you. And they keep it a paragraph, if you will, for each of the different creditors, a paragraph for your employment history, things like that. But as far as the creditors go, each creditor that you have in the last 6 years has a paragraph. And every time that creditor reported to the credit bureau, good, bad, or otherwise, every time they reported to the credit bureau, they rated you. And on the right side of this chart, you'll see what the ratings are. They go from a 1 to a 9. So if creditor A is reporting you as a R1 rating right now, that means I am current with my payment. That is good credit to have. If you have more number 1 ratings, that is going to build into a good credit score. And that creditor A has 6 years worth of information. So it may mean I'm rated number 1 today, but maybe a year ago I had fallen behind. So I was rated a year ago as a number 2 with that creditor because I was a month behind. Maybe 2 years ago, I was rated number 3. I was 2 months behind, and so on and so on. And if they start to sue you, if they start to send it to a collection agency, that becomes a number 9 rating. And all of that information for every creditor in a formula that the credit bureaus have is what makes up your credit score of hopefully 660 or higher. And how do you get your credit score? You can do it free. If you go onto Equifax or TransUnion's website, they have forms on there. You could fill it out, mail it in, they'll mail it back to you. It's all free. The last few years, there's also Credit Karma and Borrowwell, which are companies that are essentially linked to the two credit bureaus. And so you can pull your credit report from Credit Karma and Borrowwell and see what's on there and see some of your credit score. So that is what your credit score is and how it's created. Now, how do I improve it? Well, obviously paying the bill on time each month so that I am a number 1 rating. That would be ideal, but for sure, pay your minimum and the more than the minimum each month. So that's why it was important to write down at the start of this, what is my different debt and what is the minimum payment each month? Try to keep the balances on your revolving credit products. So this would be, for example, your credit cards, your store cards. Try to keep whatever your limit is, try to keep that limit at least 35% or less. So if I have a $1,000 credit card, try not to carry a balance that's more than $350 on it, because that will then start to affect your credit rating. If I'm always maxed out at the $1,000 on it, that will start to affect your credit formula. Try not maybe to close all the old accounts. So if I had 5 credit cards, let's say in the past, and as I pay it off, I close it. Now I just have 1 credit card, but I'm always maxed out. Your credit score is only going to show or going to be overinflated, I guess, to show that I'm maxed out on the only credit I have. So sometimes you may not want to close all my old accounts as I pay them off. Try to only apply for new credit, obviously, as you need it. Try to pay off the debt as you're looking at your budget. Pay off that debt rather than moving it around. If I'm moving it around, you're going to be maybe perhaps into one of the next screens I'll talk about of I need to sit down and talk to somebody. Number 6, when you do order your credit report, they send you a dispute form, and make sure you dispute any inaccuracies. The credit bureaus are not perfect. They're not a government agency, not that the government's perfect either, but make sure you're disputing any inaccuracies that you see on there. If there's balances on there that you've paid off, make sure you're checking your credit report every 1 or 2 years so that you can dispute anything that's not correct. And it does take time to fix the past, if you will, or to build up a higher credit report. It takes time for things to fall off, generally 6 years. Anything that's on your credit report generally is 6 years before it falls off. Try not to move too much or change jobs every 6 months if you can help it. That does affect your credit rating. And have a manageable variety of credit. The installment loan, like your car payment, your mortgage, your revolving loan, like a credit card, or your operating accounts like your phone and your internet, things like that. Try to have a variety. Creditors will look at that as to whether you have a variety of debt. Then what is good debt or bad debt? I mean, there is a difference. On the left chart here, you know, right now I owe more on my house than my house is worth. That would mean your mortgage is upside down. That might be okay. That might not be the, you know, still might be good debt because maybe housing prices will turn around. Fort McMurray is a great example. I saw a property tax assessment lately from a house in Fort McMurray, and the assessment a year ago was, it was a condo, so say it was 360,000, and now this year it's 260,000. You know, so different cities evolve over time. So, but you know, it'll come back again. And so even if I'm upside down on my mortgage, maybe that's still good debt that will rebound. But on the right side here, this cartoon says a credit card is what you use when something costs too much and I'm going to pay more for it because I'm going to pay for the interest and all of that. That might not be such good debt. So good debt might be your mortgage, your investments, student loans for some people maybe. Bad debt, you know, using credit to buy consumption goods, TV, clothes, furniture, things like that. That might not be good debt. And might be taking what I said earlier, the buy now, pay later thinking, and we want to switch that to plan now, pay now. That would be consumption credit. Now, what happens if and when my debt, my credit has built up too much? What are these creditors' rights? So there's two different kinds of creditors I want to talk about. There are secured creditors and there are unsecured creditors. And if you're not familiar with what the difference is, a secured creditor is somebody I owe money to, and they've taken security or collateral on one of my assets. They're secured to my house for my mortgage. A car loan generally is secured to the car. And if I don't pay that loan or contract, the secured creditor has the right to seize that asset. That's a secured creditor if I start to fall behind on that payment. An unsecured creditor doesn't have this collateral to seize. In order to seize, they've got to go through certain steps. They do have the right to sue you if you fell behind on the amount that you owe. If they get a judgment, if you're not able to work things out with them, they do have the right to garnish your income. There are some exemptions for some pension incomes, but they do have the right to garnish income, garnish bank accounts. And if they get a judgment, they can start to seize and sell assets that are not secured. CRA, Revenue Canada, if there's anybody there who owes money for past income tax or GST debt, they have a little bit more power. They do have the right to start to garnish without having to sue you. They don't have to sue you first to take those steps. And typically, if a creditor does start to pursue some of these actions and your credit score starts to drop, any of the costs that they're incurring will obviously get added on to the amount that you owe them. So they typically will have the right to collect for that. And they also have the right to pursue anybody else who maybe might be responsible for that debt. So if we've co-signed a car loan for a child, let's say, if our child does not make the payment on that car loan, creditor A now has the right to come after me for that payment. So be cautious, careful, be very aware of co-signing loans, liabilities for other people. Can I make that payment if the primary borrower does not make the payment? So those would be some of the creditor's rights if I start to fall behind. Then what if I'm really falling behind? I wanted to talk a little bit about what is insolvency. Insolvency does not mean bankruptcy. And sometimes I know as a licensed insolvency trustee, LIT, sometimes people think that coming to us for advice, that's what we do as bankruptcies, which is so not correct. It's only part of what we do. So insolvency, I usually describe it as being a state of being. I'm insolvent today. There's not enough to go around. I don't have enough income to pay my expenses. I don't have enough assets to pay all my liabilities. I owe at least $1,000 technically. And that is what insolvency is. Now, it doesn't mean I'm going to go bankrupt because of it. Bankruptcy maybe is one of the options, but there's just not enough there today. And so I need to step back and look at, okay, what am I going to do about it? What are some of the common triggers we see of insolvency? Sometimes a relationship breakdown, job loss, a reduction in income, less overtime, a reduction in my part-time hours, business failure. Unfortunately, we have seen a bit of that the last couple of years with COVID, not filing and paying my taxes, death or an illness of a partner, those unplanned expenses that I didn't budget for earlier, funeral expenses, house repairs, mental health issues, addictions, gambling, lack of budgeting that we've talked about quite a bit today. That can be a common cause of insolvency. Being aware also of fraud and scams. Before I came online today, I took a look at Canada.ca's website. And in 2020, they've reported on their website just over 71,000 cases of fraud in 2020 that cost the victim about $107 million in Canada. And in 2021, the stats that I was able to find is only to the end of November, so the year wasn't done quite yet. By that stage, there was already 68,000 instances of fraud that was reported that had cost the victims $231 million. So be very aware of fraud and scams that are out there. I don't know what the current number is, but I can tell you that these different scams has, I don't know, it's significantly increased during COVID. So be very aware of it. Be very aware of these CRA scams. You can see some of them on CRA's website. CRA will not ask you for banking information. They will not threaten arrest of you. So, you know, Google searches will show you what some of the scams are that are out there. You know, the romance scam, looking for money. Generally, these scammers are going to ask you for personal information that's not required at that moment in time. And they're going to be very aggressive. They're going to be very pressuring, which, yes, collection agencies, you know, maybe sometimes are, but CRA is they're not overly pressuring you. So if your spidey senses are tingling, you know, step back. CRA will send you a letter. CRA will send you an email, but they're not going to ask you for your banking information over the phone. Financial abuse. Be cautious and aware of that. So a power of attorney, which a lot of us hopefully have as part of our estate planning, make sure it's someone you trust. Maybe you even want to have two powers of attorney versus just one person, so that there's two people that have control of my finances if something should happen to me. Protecting your PIN numbers and your passwords, getting legal advice if you need it when it comes to powers of attorney. And again, is this person overly pressuring me to sign something or change something, changing something in my will or my power of attorney? You know, there shouldn't be overly pressure in things like that. So be cautious of those different issues. And again, as I mentioned earlier, check your credit rating every year or two. Make sure there's nothing on there as far as credit that isn't me. Okay. Now, what happens if I am insolvent? I think the main thing I'll say out of these next couple charts is that you're not alone. At the start of this age bracket here, you can see 39% of insolvencies that were filed. I think this was 2019 was the last year, or 2020, sorry. 39% of them were age 50 and over. So people definitely aren't alone. In the 50 to 64 age bracket, the most common cause was medical reasons as compared to other age brackets. And 41% of debtors also had tax debt in that age category. In the age category over age 65, the average credit card debt was over $18,000, whereas for the other age categories, it was just over $13,000. So, you know, more credit card debt over age 65. So important to nip that in the bud if we can. When we're doing our budgeting. Insolvencies in general in Canada were fairly stable over the last 10 years or so. Little bit of a spike in 2019. When COVID happened in March of 2020, insolvencies actually dropped quite significantly right across the country because creditors weren't collecting, courthouses were closed, creditors were trying to be empathetic to the situation. So the insolvencies did drop in Canada once the pandemic started. What is it looking like right now in Alberta? So we did, whoops, sorry, I apologize. Insolvencies did start to spike again in 2019 and dropped in 2020. In 2021, they have increased a little bit and did increase a bit more in November of 2021. So if you find yourself in a situation where you are struggling with debt, recognizing any of those warning signs, the sooner that we could talk about these different options, the more options that will be available. Once a creditor has seized your bank account, the bank account's gone, but maybe we can use the bank account today earlier to do something with it. Okay. And there are different options out there. And our first and foremost job as an LIT is to ensure that people have all the information they need about the different options, whether it's things that you can then do on your own, like budgeting or consolidating, talking to the creditors, a debt management program, pulling equity out of your home, reverse mortgages, things like that. We will go over all those different options with you, and then you can work through doing them. When those options don't work, we also will talk about the more formal programs. In the Bankruptcy and Insolvency Act in Canada for individuals, there's basically 3 formal programs. Orderly Payment of Debt, or OPD, which is a program for people who could pay all their debt in full by consolidating it without having to borrow money. So it will pay all my debt back at a reduced interest rate over a period of time. That is the OPD program. Then when I do need to maybe reduce some of the debt, there are options called a proposal, and there is an option, bankruptcy, which are done through a licensed trustee. But we will review all of these different options with you if you find yourself in a situation where those debt payments are just not fitting in my budget. So M&P is a licensed trustee firm in Canada. We are the largest firm in Canada, coast to coast. We have approximately 90 trustees right now. In Southern Alberta, we have different offices in Calgary, Airdrie, Red Deer, Drumheller, Lethbridge. So we do have various different offices. A lot of it is being done remotely right now online, but we do have physical offices as well for people who want to meet us in person. So again, if you are struggling with the budget and it's not all fitting, reach out to us. We can take a look at them. And we do have the various different sources of contact information, or on our Facebook page. There's things you can follow along there on our website, mnpdebt.ca. We have different information about the options to deal with my debt if I need it. We also have different resources to help you track that annual tracker that I mentioned earlier of tracking what my budget is. There's an electronic version of it on our website. We also have podcasts, a 3-minute debt break, just 3 minutes of tips every now and then. And we have different YouTube videos as well about different options and different ways to deal with debt and budgeting. So various different ways that you can reach out to us to deal with your budget and your debt. So hopefully you were able to take 1 or 2 things away from what we've gone over here today. I know it can be a lot of information to digest. So just to wrap up, I guess step number 1 is to write down where I'm at so that I can then move forward from there. And then if you need assistance with that moving forward, then we're here to help, or other nonprofit agencies as well. So I will leave it at that. And then if we have any questions, Colleen, we can go from there.
That was great presentation. Thank you very much. It's
Mhm.
wonderful, very valuable information there. And if you like, we can leave your slide up there so that people have lots of opportunity to capture. There seems to be lots of options there for people to capture more information that would be helpful for them. And we will open it for some Q&A. I have someone here that has raised a hand, so let me just look here and see if maybe I can open it. And then it's just under MRU nursing. I'm going to open it to allow you to talk, and you can unmute yourself if you like to ask your question.
Hello.
Hi, good morning.
Morning.
Hi there. My name is Holly and I'm a clinical nursing instructor, and we have 8 third-year Bachelor of Nursing students here, and we are doing our seniors health rotation in the community. So thank you. This is really, really great for our population. Couple of questions. Number one, our first question is what you meant by medical reasons for insolvency. What are some of the top medical reasons?
Probably the illness, something that has now affected my income. That would be the top reason. So anything that is affecting my income, or if I didn't have a medical plan, short-term disability, long-term disability, whether it's through my employer, or if I don't have something through my employer, do I have something of my own? So anything that's going to affect, I think, my source of income. It's not so much what the illness is, it's that it's affected my income.
Okay, so just people that work in positions that don't have benefits, for example, or require medications, like, for example, diabetic medications, which can be really expensive.
Expensive, yes.
Okay, that's good. And then second question is, you mentioned the term trustee, and I understand that's what your title is. Can you just explain how the term trustee, the way you use it, differs from the definition of a public trustee through the Office of the Public Guardian and Trustee?
Okay, so LIT, Licensed Insolvency Trustee, is our designation. So similar to a lawyer going through school, and when they're done their schooling, they get accepted to the bar from the Law Society, and then they go to work at a firm. So we have an association as well. And so a trustee, in my sense, we go through our educational program and the experience that we're required to get, and the exams, if you will. And if the very last stage of a trustee exam for me, it's an oral exam. We've done all the written ones, and then there's an oral board exam at the end, and it's before a panel, which includes the Office of the Superintendent of Bankruptcy. And after that oral board exam, the OSB, the government, makes a decision as to whether to give somebody their license as an LIT. And then an LIT goes to work for a firm. So in my case, once I got my license, I went to work at M&P. And so it's a trustee because we do hold assets in trust. When we work through a proposal, when we work through a bankruptcy, if we're doing a corporate file, a receivership, we are holding assets and money in trust. We have numerous different trust accounts, and we are ensuring that that equity and assets is getting to where it needs to go pursuant to the law. And so it's a trustee in that sense versus a public trustee, which is assisting the family of somebody who's maybe passed away and there was no will, there was no executors. And so the public trustee is going to take the assets and stuff that was left and getting it to where it's supposed to go. So it's an insolvency trustee. So we're helping people and companies with debt options and perhaps holding things in trust while we do it.
Great, thank you so much. And my very last question, what happened in 2011 that caused so many bankruptcies?
2011 would be the tail end of the housing, 2011 would be the oil field. So in 2008 and 09, we saw the housing crisis, which hit North America, and we saw insolvencies right across the country increased. And then in 2019, then we started to see the oil field. And when you look at the statistics across the country in 2019, so the country was kind of holding its own. Alberta insolvencies increased about 14%, and the country about 9%, and it was all relating to the oil field provinces. Alberta, Saskatchewan, Newfoundland got hit. In 2020, when COVID hit, then insolvencies dropped about 20 or 30% actually. And now in 2021 in Canada, insolvencies are still down about 6%, whereas in Alberta, they're back up again about 8%. We've kind of been double hit in the oil provinces between the oil crash and then COVID. And I can tell you from our personal practices in February of 2020, we were meeting with record numbers of peoples. And then when COVID hit, because collections stopped, insolvencies dropped. But we all know the debt hasn't, for the most part, disappeared. So again, like I said earlier, in November last year, insolvencies in Alberta did start to increase, and I fear that that debt is still out there. So for us, it was the oil field and then COVID double whammied.
Excellent. Thank you so much.
Good questions.
Thanks very much. The great questions. We appreciate you, and we'll let you. We'll get you muted there again. And thanks very much for joining us. It's great to have the nursing students joining us here today. We'll look forward to having you again. We've got several other questions and great answers there, Donna. And I think you're absolutely right, is we can't get too complacent, because we had some government support and there was a lot of forgiveness in this last couple of years, but I don't imagine that that's going to last too much longer for those people that are finding themselves in a debt situation. We've got a few questions here in chat, and mainly great accolades, very good, excellent information. Thank you very much. And we have a few in Q&A here. Lena would like to know, when one downloads a budget app, how secure is that app when you're entering all your banking information in it? Scammers and hackers are increasing.
Mm-hmm. Great question. And I won't purport by any stretch to be an IT expert. And so if you don't feel comfortable with that app, or they're asking you stuff they shouldn't be, then don't do it. The app should, I'm plugging in stuff. Here's my income, here's my expenses, I'm tracking it, but there's no bank account number attached to it. There's no social insurance number attached to it, personal stuff like that. Like if somebody found out, I guess, that I spent $600 on my groceries instead of $500, no harm, no foul. But it would be bad if they found my SIN number, my bank account number, my address, things like that. So if it's asking you for personal information on a personal basis, I'd be cautious of those. Talk to the company. The banks probably, maybe you're more comfortable with your bank, or if not comfortable at all, go back to the old-fashioned way. Just create a spreadsheet on your computer and track it that way.
I know I myself tend to use Excel. And so I try to do my monthly budgeting. I've learned through this presentation that I maybe need to go into it a little bit more in depth, but just using a simple Excel for your expenses, revenue and expenses is easy enough and private. Vivian says, thank you very much for such a comprehensive presentation. And Anonymous would like to know, is there a fee for an initial consultation?
No, there's not. Our initial consultations are free. If you are paying someone for the advice, you should not have to. So for LITs, our initial consultations are free. You don't know if you need us when you come in to meet with us. Our job is to give you information. Then if you do need something more formal, we'll talk about how the fees work, and the fees are legislated. They're not magic numbers that we're picking out of the air. We will talk about the fees if you need something more formal. But that initial consultation, which is usually, an hour to an hour and a half, depending on what somebody's situation is, those are free.
Great. So worth reaching out if you have any questions. Yep. This is something that is a bit of a bugaboo for me personally as well. Mina has asked, what is Credit Karma? She knows Equifax and TransUnion, but you mentioned Karma. And also, if we have checked with Equifax, is it enough, or do we need to go to other agencies as well? Do you need more than one agency?
Good question. So again, there's two credit bureaus, the Equifax and TransUnion. Credit Karma and Borrowell are not credit reporting agencies, credit bureaus. So there's just the two, and different lenders use different ones of those. So you may see creditor A reporting to Equifax, but creditor B maybe uses TransUnion. They're just different companies that they report to. So it's good for you to check both of those. The Credit Karma and the Borrowell that have evolved over the years are really just a data mining maybe. So they can get the information from Equifax to give you a snapshot report. If you want the most detailed report you can get, it's right from the source. It's right from Equifax and TransUnion. Credit Karma and Borrowell are just a reporting agency. They'll show you who you owe money to today. But if you want detailed information of what's going in there, what my credit score is, stuff like that, you've got to go back to the credit bureaus, and you should check both, yes.
That's good information to have. I know that my bone of contention with Credit Karma is that I've been registered with them now for a few years, and they keep sending me here, check your report. We've got a new report, check your report. But for whatever reason, they don't recognize my password. I've never been able to get into the darn thing. I have emailed and emailed and emailed, that I can't change the password. You have to go to them to change it, and nobody ever gets back to you. And I'm going. So sometimes I get a little sarcastic. I'll get an email saying, here's your new report. And I'm going, I'd love to be able to open it.
Yeah, always better to go to the source for sure.
You know what? That's great advice. And I think that's what I will do. We'll just, we'll delete that out of the system and go directly to the source. Thank you.
Yeah.
And we've got a chat here. Stephen has said, if you're not paying for the app, you are the product. So I guess going back to that conversation about whether or not you were opening yourself up, I guess. And a couple more Q&As here. Mina said, thank you very much. Jay has said that a lot of banks offer free online credit checking to their customers. So that might be worth checking into if you're looking to see where you're at with your so I think, when going back to that, keeping track of your credit score sounds like it is a valuable thing to do. And when you do look at your credit score and maybe it's under that 600 points, how do you go about improving your credit score? And I think you touched upon a few things there as far as, making sure that you're making the regular payments and things like that. Is there anything else that we can expound upon there?
I think we touched on most of those earlier. Obviously you don't want to have 10 credit cards. If I do, there's probably a bigger picture discussion to have as you're trying to pay down that debt. Some people will look in their budgeting at paying off the highest interest rate one first, which makes sense because I'll save more money that way. But sometimes I want to take that $1,000 credit card versus the $5,000 ones, and I just want to get rid of one. I want to get rid of one, so now I'm only dealing with 4, and have a sense of accomplishment almost to get rid of the smaller one first. So there's pros and cons of paying the highest interest rate one first versus paying maybe a small one off first. Pros and cons to both, depending on, I guess, what your relationship with money is too, as to what would make me feel like I'm getting somewhere.
So maybe instead of paying a little bit on all of them, paying off that lower one and kind of incrementally getting rid of them might be better.
Yeah, you want to keep up with the minimum payments for sure, but when you're looking at your budget, if there's room left there, maybe I want to pay off the smallest one first while I maintain the minimums on the other.
Your payment calculator was quite eye-opening there,
isn't it?
Yeah. You don't realize, and I think that was one of the things while you were speaking as well, that that I think a lot of people kind of out of sight, out of mind, in these days of all billing online, and you're ordering services online, and they're just automatically debiting your Visa or your bank account, sometimes you go in to review your bank account, you're going, holy cow, I paid an awful lot for these services that I may or may not be using. So as you said, to review from time to time. And one of the things, as far the other thing too, with the budgeting, setting yourself up to be able to budget effectively. I think one of the things we're all seeing, through this COVID period, we're using more online services for grocery deliveries and things like that may be increasing costs. We've all seen, in the meat departments and the grocery stores, the increased costs for things. So, I think when you're setting up your budgeting, trying to account for that inflation, and I think that's a lot of seniors are going to see that affecting their budgets and their disposable income here over the next little while until pricing settles down again.
So true with groceries right now, isn't it?
It's crazy. It was funny. I walked into Sobeys the other day, and they had a particularly good sale on some meats. And I was stunned because I'm going, oh my God, this almost seems like it's back to normal. But so I think everybody seems to be talking about the increased cost for groceries. And I think that, we may need to be looking at amending our budgets to account for that. So anyone else have anything that they might like to ask Donna? It's been great information sharing. Thank you, Donna.